Good morning, everyone. Thank you so much for joining us. It seems crazy that the last time we spoke was on the 8th of August. It feels like last week. I just want to say, miss you all madly. So everything's changed, so much has changed, and essentially nothing has changed. And that's what we're going to talk about. We've got Reuben and Abri and Cassie who have joined us from the portfolio management team. And what we based today's presentation on is that the only certainty appears to be uncertainty. And so that's one of those profound, irritating adages that we can always rely on. So there's a lot of narrative at the moment. There will definitely be a recession, probably, maybe. And Cassie, Reuben, not yet. Reuben, thank you. Cassie just circulated a piece that he bought, that he banked from the Zebra, who said in May with absolute certainty that there was undoubtedly going to be a recession and that by later this year, the Fed will definitely have started cutting rates. So it's impossible to know what's happening. It's even dangerous to say after the fact that it happened, because like, did it really? Who really knows? So anyway, what we're basing this on is the only certainty being uncertainty. Fortunately, bonds will be less risky than equities. Everything that we took as being absolute is being questioned. And then there was no ways that the Springboks could possibly win by 1 point again. So my nerves. So the only certainty is uncertainty. Thank you, Reuben. So what we're going to do is we're going to start, we've called this invested for the unexpected. So that basically creates an environment for everything. When we met on the 8th of August, we went into quite a lot of detail about the supporting indicators. And the reason for that is that this is particularly relevant when we are out of equities. I think when God's in his heaven and all is right with the world and equities are running and we're 100% exposed to equities, we'll just be basically checking out the movies, getting our manicures updated and traveling the world. But while we're out of equities, it's very useful for us to be able to explain to you what these supporting indicators are telling us. So we went into quite a lot of detail about the supporting indicators, and we also went into a bit of detail about 2 concerns that we have which relate to China and to equity valuations. So this is going to be our starting point. Thank you, Reuben. And I think this is such a profoundly useful quotation from Henry David Thoreau. It's not what you look at that matters. It's what you see. And sometimes you have to blink a few times, and every time you do, you're quite likely to see something new. So thanks, Reuben. So now what I'm going to do is we're going to spend some time reflecting on what we said last time. It won't be me, because what I say will be fascinating, but it might bear no relation at all to what we actually said. So I'm going to hand over to Reuben. If you do have any questions, you're very welcome to interrupt or redirect or put it into the chat, but we will otherwise take questions at the end. We really want to try and keep this into a 30-minute slot. And so, Reuben, if you'll take it now.
Great. Thanks, Megan, and thanks everyone for joining us. Where do we find ourselves right now? And yeah, I think there's a sense of deja vu. If we go back 12 months ago, markets were generally bullish. I think the general sentiment was that China was going to reopen. They would drive commodity prices up. South African equities were considered cheap. And so we certainly held the minority view 12 months ago. Over the course of the past 12 months, markets have been up, markets have been down, and yeah, essentially cash has been the asset class that has delivered. We look around us and see that most of what has been delivered is in fact return-free risk. And I think that becomes clear when we look at this chart over here. As I said, markets were up, markets were down. And if one looks at the major asset classes in South Africa over the past 12 months, then certainly equities have been up 8.3, bonds 7.9, cash 7.73, and the average multi-asset fund up 6.52. Just an interesting statistic, while the JSE All Share has been up more than 8%, the average fund manager in South Africa has only given his clients a return of 3%. So looking at how we were positioned over the past 12 months, this is a very simple chart just detailing the various asset classes that we were exposed to. 12 months ago, we were exposed to offshore cash and local cash. We moved out of offshore cash, and for a short period of time, we're in local bonds and then in some offshore cash. But traditionally, or generally, should I say, our exposure has been to local cash, bearing in mind that we've got a very good return from local cash, and on a risk-adjusted basis, that was our asset class of preference. So, as I said a year ago, markets were generally, or investors in markets were generally quite positive. We saw a bit of a bounce, but most of that bounce has in fact been whittled away over time, and markets generally, equities in particular, not looking great over the past 12 months. The other view that was almost consensus in the market was the fact that China was going to rebound. Our view was way out of consensus at that point in time, and was premised very simply on the fact that we did not see strength in the USA manufacturing component of the economy. What we have here is the light green line, which is the USA ISM, and it was portending weakness in our perspective 12 months ago. And we said it was unlikely that China would be strong in a general environment of US manufacturing weakness. As things panned out, that was indeed the case. And one can see there's still not a huge amount of strength being forecast by the ISM and the Chinese PMI. So it remains a concern. So then, if we add the returns that we have generated over the past 12 months to the returns generated by those major asset classes, you will see that the Gryphon Prudential Fund has returned 9% over the course of the past 12 months, which is in excess of those various asset classes. So what we have effectively given our investors is an uncrowded and uncorrelated 9% return, which we are proud of, but certainly one which has avoided the huge volatility that's been in the markets over the past 12 months. So right now, where do we see ourselves? In July 23, August 23, we summarized our view by comparing what the bullish view was in the market against the bearish view in the market. We are going to do the same today, and interestingly, the only difference between these two slides is the date. So we maintain our broad view that when it comes to inflation, sticky price inflation has not been resolved. We see rates remaining higher for longer. That was an out of consensus view 12 months ago, and it has now become a consensus view. We are quite concerned about earnings. Once again, against consensus, we see that a lot of the pressure from rate hikes are still to be felt on corporates, on the consumer, and on government, and I'll show you a slide or two on each of those. And then when it comes to interest rates, we did spend some time on this, but there is no alternative. The TINA approach to investing no longer applies, and certainly cash is offering investors a low-risk alternative at decent yields, both locally and internationally. And then when it comes to global markets, we don't think that asset prices have incorporated the fact that interest rates are going to stay higher, and we continue to think that valuations are excessive. I'm not going to spend a lot of time on this, but certainly from a valuation perspective, the S&P price-earnings ratio remains elevated, and we don't believe it reflects the risks that are applicable to equity earnings and equity prices right now. Inflation, you'll see in the US and in South Africa, has come down. We certainly believe that that was likely to be the case, but the concern is that there's a little bit of a bounce here, what is in fact happening is that the base effect is coming through. I'll show you this in the next chart, but certainly inflation not as low as where markets predicted it would be 12 months ago. Our concern relates mostly to what the Federal Reserve Bank of Atlanta refers to as sticky price inflation. Just a reminder here that sticky price inflation was very, very well behaved up until about 2021, around 2%, 3%. It then ballooned to ahead of 5%, and in line with our concerns, is not coming down as quickly as anticipated. The base effects here in the flexible inflation, which are mostly transport-related costs, are likely to result in that heading up slightly, which we don't think portends positively for overall inflation. We get an inflation print in the US today, so we'll see what that looks like. And we've also just given you the difference between the flexible and the sticky inflation over the course of the past 15 months or so. When it comes to quantitative easing, certainly the Fed is taking liquidity out of the market. And apart from that little blip around the small cap banks in the US, we see quantitative easing has now become quantitative tightening. And we see that as a headwind to asset prices generally internationally. When it comes to US earnings, our concern remains that underlying analysts, equity analysts, are still too bullish when it comes to forecasts over the course of the next 12 months. You may recall that 12 months ago, there were very few people predicting the fact that earnings would decline. Earnings have in fact declined, and we're not 100% sure that that decline is complete. You'll see this when you look at the earnings profile. Earnings have come down, they have bounced slightly, but we are not 100% sure that there's going to be a strong rise from this point onward. The impact for equities is significant, and what we've shown you here is just a simple chart of Microsoft and Alphabet. Now, Microsoft surprised the market. The market re-rated their shares up. But what you have here is also the disappointment from Alphabet. And one can see here that the decline exceeds the increase. So we do think that markets are not priced for earnings declines, which we think is the likelihood. What we also have here is analyst upgrades versus downgrades. And you can see here over the recent past how downgrades have in fact increased over time. And so we remain concerned about earnings going forward. A further factor which we believe is going to impact earnings is interest payments. Now, up until this point in time, that has not been the case, and I must say that has been against our expectations somewhat. But what has in fact happened is that interest payments are generally fixed and were fixed by corporate treasurers during the course of COVID when interest rates were very, very low, while interest receipts, in other words, interest income on cash holdings, have been variable. So what has happened is that interest income has increased while interest payments have remained stable, and that has resulted in the most recent past in the net interest expense declining. We do, however, see that coming to an end. And in this chart from Bank of America, we show you how financing costs are increasingly a concern of corporate CEOs. So that's as it applies to corporates. That same principle applies to the consumer. So this is a chart which focuses on the United Kingdom, and this is the interest paid by homeowners in the UK. And one can see here that should homeowners refinance at the current rate, the current refinance rate will be considerably higher than the rate they are currently paying. Now, if I can just spend a moment on this, there are a number of people in the market that say, well, mortgage rates in the US are not really a problem because mortgage rates in the US are fixed. So there's no problem with regard to the consumer because they will pay very low interest rates for an extended period of time. A very similar argument was brought forward in 2008. And the only problem with the argument was when people started losing their jobs they had to sell their houses. When they sold their houses, the low-rated mortgage bond on their property was lost. They then had to buy a house in a different city, a different location, and they had to refinance that purchase at higher interest rates. So should no one lose their jobs, they certainly will enjoy those low rates for a long time. The history indicates that that is not the case. And when the job market turns, people have the double whammy of not only having to look for a job, but also having to service a higher rate of interest on their home mortgage. The other thing that's important from a consumer perspective, and one of the reasons why the US economy has remained stronger than certainly our anticipation and the anticipation of many economists, is that the fiscal largesse provided by the US government has certainly lasted for an extended period of time. You'll recall that payments were made in COVID, and this boosted the savings of the average US consumer. There are a number of ways of calculating this, but the general view is that these excess savings are coming to an end. One can also see here, when it relates to the consumer, how personal interest payments as a percentage of personal wages and salaries have rapidly started to increase, but only very recently. So as it pertains to corporates and it pertains to the consumer, we see interest and interest payments becoming an increasing portion of their budget. But that's not all. This also applies to the finance of the government. So as you will know, the US economy runs on a deficit, and that deficit must be financed. What we have here is an indication of the net interest cost as a percentage of tax revenue. And one can also see how this has steeply increased over the very recent past. Now, that is now 14% of tax revenue. And historically in the past, this has been an inflection point, because then governments realize that they have to cut back on spending, and there'll be less fiscal stimulus provided to the US economy. So from the perspective of us going forward, our concern remains that interest payments are going to be an increasing headwind to corporates, to consumers, and to the government. And that's one of the major reasons why we are not as bullish on earnings going forward as the general consensus. We'd like to conclude with 3 points for discussion. And these are 3 points which we have come across over time in the course of the market. There are 2 indicators, the US yield gap and Psalms rule, which many of our peers are of the view are not going to work in the current market downturn for various reasons. In the case of the US yield gap, because of quantitative easing, and in the case of Psalms rule, because of the change in the US employment market under COVID. We differ with those consensus views, and we'll explain to you why. So starting with the US yield gap, it's effectively the difference between the 10-year yield and the 2-year yield. That's the one yield gap that we follow quite closely. And what you have here is that yield gap, that difference, and the shaded areas are the periods of recession in the US economy. And what we're trying to show here is that on each occasion that this yield gap drops below the zero line, at some point following that drop, there is a recession in the US. This indicator has never failed over the course of the past 40 years. And so we don't really agree with those who say that it's different this time. However, we'd also like to point out that the difficulty generally only commences once the yield gap starts normalizing. So you'll see here it has started to turn around, and we believe that we are getting closer and closer to the point where the US economy is going to experience some degree of difficulty. A further yield gap that we watch is the 10-year, less the 3-month Treasury. And in 2019, this gave us a better steer of where the US economy was headed. And this, like the 10-year less the 2-year, gives a very clear indication that once that turn in the yield gap takes place, it is followed by a US recession. we remain cautious by virtue of these two indicators. And then I'd like to refer to a very interesting rule called SARM's rule, and it relates to the US unemployment stats and particularly the unemployment ratio. So at this point in time, we have an unemployment percentage of 3.9% in the US economy. You'll see here, if you look through this chart, which goes back to the 1950s, that generally unemployment bottoms out just ahead of a recession. And we think, once again, this is an indicator which confirms our concern about the recession. So to just give you some indication of what this rule entails, we've notated it here for you. It says simply that if the 3-month average of the unemployment rate is half a percentage point or more above its low in the prior 12 months, then it's a very good indication that the economy is in a recession. So this was a rule developed by Claudius Sam, who was a former Federal Reserve economist. The current reading on that indicator is 0.43. But it's a supposedly foolproof indicator, not just for predicting recession, but signaling that one is about to start. The rise in the unemployment rate in last Friday's payroll report puts it at the highest point since January 2022 at 3.9%, and a half a percentage point above the low of 3.4. So bear in mind, SARM's rule is that it must be 50 basis points or half a percent above the moving average of the prior 3 months. And then if you do that calculation, you'll see I've recorded the calculation over here. The low point in the past 12 months was in January at 3.4%. That reading is now at 0.43%. And then just to go back and look at the long-term history, you'll see here that the jobless rate is very close to triggering that rule, which indicates, in our view, that we are pretty close to recessionary conditions in the United States. So in conclusion, a final thought. This is a gentleman by the name of Brian Feroldi. He's quite active on Twitter, and he makes the following point, and a point which we believe is very valid. We increasingly face the view in the market that it's not timing the market that's important, but time in the market. And we would like to just caution investors about that view by looking at what this gentleman comes up with and some of the research that he's done over the course of the very long term. He says the following: the stock market occasionally gives you nothing. Sometimes you get zero returns for years. Some investors believe that we are in one of those periods right now and are predicting that stock returns will be near zero for the 2020s. Given valuations, rising interest rates, and other macro concerns, that's not out of the question. If true, that will be a tough pill to swallow. So let's look at those periods that he refers to. Those of you who are old enough will certainly remember this period in the United States S&P 500 history from September 2000 to May 2013. There was a 12.8-year period where you got no returns from the US stock market. So in other words, if you invested in October 2000 up until May 2013, your return on your investment in US equities would have been zero. There have been other periods, and they are all notated here. You can go have a look at them over time. But the interesting thing is, if you add up these various periods, you'll get to a period of more than 60 years where you have got no return from US stock markets. And so when it comes to time in the market, one must be very cautious that you are not in one of these extended periods where you are likely to experience very little or no returns from equities. This is our Prudential Fund, and looking at the returns which we have generated over the course of the past 115 months, that's almost 10 years. It will be 10 years at the end of March 2024. I think you know this chart reasonably well. The shaded area is the 19 months that we were in equities. The unshaded areas are the 2 periods where we were out of equities. The purple line is the Prudential Fund return over this period. The dark blue line is the all bond return over this period. The red line, equities. The green line, dark green line, what cash has given you. And the black line is the average multi-asset high equity fund in South Africa. I do think that the return profile that we have provided you as investors has not only preserved NAV, it has been, in terms of volatility, far lower than any of the competing asset classes or our peers. And certainly we continue to generate a very solid return for our investors. Looking at that return from a compound annual growth return per annum, what we show you here is that the flexible and Prudential Fund have returned 9.5% on a CAGR basis. They've exceeded equities at 7.6, bonds at 7.6. And very importantly, while many of our investors or many prospective investors look to us and say you are very conservatively positioned, you are only in cash, we have, over the course of that 115 months, added 3.1% per annum to cash by making cash sweat. Most of you will know how we have done that by looking at alternative investments in not only foreign currency, but also bonds. But certainly that has been a consistent ability to generate returns which are not only superior to the competing asset classes, but in particular superior to cash. We think that's very significant because, as Megan has asked the question over there, how is your living annuity looking? So if one looks at investors in a living annuity, if they should be in a period of zero returns from equities for an extended period of time, that becomes quite serious because they literally end up eating into their capital. Our solution overcomes that weakness in that we've been able to provide a return, notwithstanding the fact that we are conservatively positioned. I thank you for your time, and I'll hand back to Megan.
Great stuff. Thank you. Thank you, Reuben. Yeah, Mr. Winston Churchill, the further backwards you can look, the further forward you can see. So from my perspective, working with this team, there's an enormous amount of time and energy and intellectual resource that is committed to contemplation, but this doesn't help unless it's being applied to an open mind. And it never ceases to amaze me the extent of openness in the minds here. So I'm sharing with you a piece that I'm preparing to write, so that's why it's present.